Welcome to Building Better Communities with Bob Hart, the podcast that dives into the stories of the leaders in commercial real estate and beyond as they talk about their careers, the market, and what it takes to build better communities. On today's episode, Willy Walker, Chairman and Chief Executive Officer of Walker Dunlop, joins Bob on the podcast. Now for your host, Bob Hart.
Good morning, everybody. This is Bob Hart, and I have my very, very special guest and someone I consider a good friend, Willy Walker, on the Building Better Communities podcast. Willy, welcome. Good to see you in good form.
Thanks, Bob. Always great to see you. I wish I was seeing you in person rather than over a Zoom link, but I'll see you soon enough in person, and super appreciative of you having me.
I'll take what I can get, Willy, because I know you're busy. This morning I was thinking about the relationship I've had with you and your company, and whenever I go to my coat closet in the morning, I have a choice of fashion because you have the best swag of anybody in the real estate industry. So this morning, you can see I wore
I love it. But I have to tell you, I could just as easily be carrying a True America tote bag or a number of other things that you've sent me over the years. So we both have been fortunate enough to be adorned with swag from one another.
Right. What we should do is have a subtext on the swag, and it comes out after the Sun Valley to put, remember when, there's always some fun thing. Remember when Jamie Lee upstaged Willy or tried to, or remember this or that, because you always have such epic conferences, and it's really been a true leadership for you in the industry, and you make it fun, and it makes it, it's great contextual information and good sharing. So, well, you started that many years ago. How long has that been going on, the conference?
Oh boy, Bob. In its current sort of incarnation, it's probably been going on since about 2010. But it started as a get together of a bunch of Walker and Dunlop or Green Park Financial, which was our old Fannie Mae dust company. It didn't have a direct sales force. We took loans through to Fannie Mae at Green Park through mortgage brokers across the country. And so that meeting actually started out where our correspondents would get together in Sun Valley for a kind of, let's talk about the markets and see how everyone's doing. And so it was a small group gathering of, 25 people. And then I made the decision when we started to build up our own sales force and I shouldn't say move away from correspondence because we still have correspondence to the company, but we really started to build up our own client base. And in the process of that conference got going and started at 100 people and then moved to 300 people and now is at 600 to 700 people. And as you rightfully say, is a really great annual gathering of people in Sun Valley.
Yeah, I haven't really seen anybody else in the industry put on a conference with the same depth that you guys have done, and it's obvious you invest heavily in it. So it's amazing you went from company town hall meeting to industry-wide mega gathering that people fly to Sun Valley, Willy. That's a two-flight city for many people, so you should be very proud of that. And I know why you like Sun Valley.
Increasingly more one flights like people like you, Bob, but we'll leave that on the side.
Well, we have to splurge on that once in a while for Willy. Okay. So think of all the GDP you're creating just from that conference, right?
The idea behind it, Bob, was the Allen and Company Media Conference, which happens every year just before our conference. And I looked at that conference and the investment. And I remember very clearly when I first decided to put serious money into our Sun Valley conference, I had a lot of pushback because the bankers and brokers at Walker Dunlop were used to, they thought that taking a client to play golf or going to a fancy dinner or whatever the case was, that kind of one-to-one marketing was far more valuable than some big event that we were putting huge amounts of money into. And I had to do some real internal convincing to say, if you invest in the broader event, you're going to get more people and it's going to be more memorable than that one-to-one interaction. And that was not an easy sell, to be honest with you. But in hindsight, it's clearly it's not only paid off in the sense of the brand and the experience that our clients have, but I would also say that we've been super lucky as it relates to the guests that we've been able to bring into Sun Valley. And and quite honestly, just like the Allen and Company conference, not have to pay for them. There are clearly those guests that I write checks to, of people that I don't know, but there are also a lot of people, as you remember from last summer. I had
Hmm.
both Barry Sternlicht and Strauss Zelnick, two amazing CEOs, come in and talk to us, and they're both friends, and so they don't charge me a speaking fee, and we get all of their incredible insights and comments without me having to write a big check, and they're doing it because they like the firm, they like us, they like engaging with the people who are there, and that's an incredible testament to the company and to the friends we've made both in our industry and outside of our industry.
Well, you've certainly created a wider view through bringing people in to speak outside the industry. People like Condoleezza Rice, and I remember you had a marketing person, I think from Goldman Sachs. You had some very interesting people.
I will say Condi Rice was quite something. I'm actually working on my 25 speakers right now, and I don't have there are two people that I'm working on right now that I have a pretty good line of sight that they're going to say yes, but I don't have them in the boat yet.
Yeah.
But very much in the vein of someone like Condi Rice. Condi Rice was incredible, and just her perspectives. But I mean, as you know, we've had generals, we've had Nick Saban come talk about coaching football. We've had former politicians, existing politicians. We had Paul Ryan, who came out and spoke right after he stepped down as Speaker of the House, to give us a sense of where things were. And I think
I
one of the
remember
interesting things about that, Bob, as you recall, someone like Paul Ryan could be far more open and insightful, if you will, on the politics of the day, having just stepped down as Speaker of the House, rather than if we'd gotten him when he was the acting Speaker, because he
that. Right.
doesn't have the ability to speak openly at that time, and he's got too much politics involved with what he's doing and what he says. So that was a wonderful timing of that. Kevin Warsh, who was on the Federal Reserve Board and was just discussed to be Treasury Secretary by incoming President-elect Trump. Kevin Warsh came, and right after he stepped down from the Federal Reserve, we had him come out, and he could talk about rates in a much more, open way than if he were still on the Federal Reserve Board. And so it's those types of engagements that I find to be super interesting. And again, without tipping my hand, I'm working on two people who were just very much in the midst of power, who will be out of power and hopefully have the ability to come talk to us with a little bit more liberty than they would when they were in their previous roles. So we'll see.
All right. Well, that'd be great. It's like the Davos of multifamily financing. So, but Willie, I mean, a lot of people are very familiar with your background, but I thought it'd be worth to just, as you go forward, it's always reflective to look backward a little bit. I mean, your grandfather started the company, I think, in 1937. So we're 87 plus years in this business. You've taken over the company from your dad. You worked in other industries before this, which gave you perspective, I think, after HBS. And then I believe you came over in 2003. So it's been over 2 decades now. Amazing transformation from, I don't know, 40 plus employees and 25 million of value to 5 billion market cap and public company. And I don't know, I think you've made over 20 acquisitions and some big ones recently in affordable housing and other areas. So maybe we talk a little bit about, because it's informative particularly for people coming up through the industry, how you go from that platform at a kind of a local company to being a national and an international force now in a span of a couple of decades.
Well, so first of all, Bob, just like you, I've been really fortunate to build great teams. And while Bob Hart has a huge name in our industry, and there are plenty of people who both watch the Walker webcast and who look at what I've done as CEO of Walker Dunlop and say, job well done. It is honestly due to the team that we've built and the people that I've been really fortunate to bring into W&D and help me build this enterprise. I think the other thing that, as you extremely well know, having run public companies as well as private
Mhm.
companies, um, the path and the journey that you go down, it's rarely charted. It's not like, oh, this is exactly where we're going to go and
No,
what we're going to do. There's a lot of, there's a lot of reactive management as well as proactive management. And I think that for for us, one of the one of the great things that I was able to bring to a family company was having worked in other industries and in other companies for a decade before I came to the family business. I didn't really have any interest in coming to Walker and Dunlop, to be honest with you, when I got
Hmm.
out of undergrad and got out of business school. I had been doing anything but mortgage finance and commercial real estate. I took one course at Harvard on real estate, and that was basically it. And I don't think people really thought that I was going to come to Walker and Dunlop at any point. The fact that I did, and it's turned into the company that it has, is great and fun. But
Well, Bill, Willie, sorry to interrupt you. What set that in motion? Because something, a switch flipped somewhere. I don't know if it was your dad, at his age, there was a transition. Like what caused the switch to flip?
it's funny. It was. I'd spent a decade, Bob, basically living in Latin America and in Europe,
Right.
and had thought that my future job was going to be CEO of some Fortune 500 company, nowhere related to commercial real estate. And we were living in London and had just had our first child.
No
And
shit.
after having spent my entire life and career sort of not feeling like I had to be home or close to where my parents were or whatever else, all of a sudden this sort of homing device went off inside of me that sort of said, hey, you've got your first child, maybe be a little bit closer to your
Really?
roots and where you grew up. And so we were thinking about coming back to the States, and I was on the board of Walker and Dunlop at that time. And
Oh,
as
you
you,
are? Okay.
yeah, I was on the board and trying to help my dad from a board standpoint. And I did an
That was prior to
offsite.
going public.
What's that?
Prior to it going public.
Oh boy, way prior, as you
Right.
accurately say, it was 46 employees, and we thought the company was worth about $25 million, fully private. And I did an offsite with the senior management team, and we did it out by Dulles Airport. I'd flown in from London to do it, and as I was leaving to go back to London, I turned to my dad and I said, there's a lot you can do with this company. And he said, and I said, I think I could help you. And he said, well, I've always known you could help me. I just didn't think you had any interest in it. And it was that combination of me sort of saying to him, I think I could help you, and us just having had our first child. But when I came back to Walker Dunlop, Bob, a lot of people thought that I was coming back just to sell the firm. And that, I was kind of coming back to
You
be
did
the,
the opposite.
and well, it turned out to be the opposite. But I will tell you, it wasn't like there was some grand plan other than what I didn't want to have happen was that I came back and people sort of said, oh, you just kind of came back to be a steward of the family company. So I came back with a very sort of ambitious growth objective to sort of say, I'm going to put my mark on this company. I would say in hindsight, I probably sort of I was a little bit too aggressive in all of that. My father should get great credit for having put up with me being very assertive and stepping in and taking control of things long before, quite honestly, most people would have allowed me to do it.
Right.
But I will say, because I'd gone out and run significant businesses before coming to Walker and Dunlop, and Walker and Dunlop was much smaller than businesses
Yeah.
my dad had seen me run, he had confidence that I'd figure it out.
It's almost like you went to business school after you went to business school
Yeah.
because you learned and appreciated what it was like in other companies and probably had some good cultures and some bad cultures. But Willie, a lot of legacy companies don't work. There's fights sometimes, disagreements. You've all the conferences I've always seen your dad. You've always honored his legacy with the company. So there was obviously a very good, respectful relationship there between the two of you.
Very much so. But as you know, let's be honest about it. If you look at it on paper and you look at the success and a $25 million company turning into a $5 billion company, everyone says, "Oh, that's all ups." Believe me, there were plenty of days that were difficult
Yeah.
decisions,
Could be
and
4.8 billion today and 5.2 tomorrow, but I know you don't
we,
look at the stock price anymore.
well, yeah, exactly. Well, the bottom line on it all is that I give my dad great credit because I think one of the other things that he learned, because he stepped into a family company and
Right.
worked for his father, who did not relinquish control to him, did not give him the ability to run the company until my grandfather was, much, much older. And I think that my dad saw the difficulties in that when he was coming into Walker and Dunlop. And so
Mhm.
he wanted to make sure that he didn't commit the same mistake. And And look, in hindsight, he did exactly the right thing. But I also want to say that at the time, I'm also reflecting on it, knowing that my dad was a very mature and thoughtful leader in allowing me to do the things that I did.
Well, it's worked out very well, and the stock's done well. You've done well. The industry has done well. Um, but there was definitely a shift in your thinking as you joined the company because you decided to go public. Was it the opportunity to, realize some shareholder value over years? Was it to build growth capital? Because being a public company is not an easy thing. It does provide growth capital, but it's you're always having someone look at you quarter to quarter.
So you know that as well as anyone that I know because you've done it yourself.
Well, when I was at Kennedy Wilson, and he'll deny it when he's on my podcast, but Bill used to say, "Bob, you got to sell something. We got to do something to get the stock moving." I'd sell something, the stock wouldn't move. I said, "We should have held it longer." So there's a lot of demand pressures that the public markets put on you.
So I guess there are a couple things. One, I was just my eldest son turned 22 yesterday, and in going back and looking at old pictures of Jack's birthdays, I came across the picture of us going public on December 20th, 2010. So exactly 14 years ago today was the day that we went public on the New York Stock Exchange.
Oh my God,
Yeah,
epic!
yeah. And I
I'm
was
so glad we're
looking.
doing this today.
It's a fun photo. I have a little bit less gray hair.
You don't have it
And
handy, do you?
I do. I have it right here. Yeah, it's right. It's right on my. I actually have an email that I was
Let me see.
going to
Let the viewers see it.
I was going to send out to all Walker Dunlop employees
I've been
today.
on that NYSE stage when we went public, at
Yeah,
Kennedy Wilson. It was
it's
amazing.
it's fun. It's right there.
Oh, look at
There it
that.
is. Yeah,
We're okay.
and you can see December 20th, 2010, right there in the
All
middle.
right. So
And
how many of
so
those people are still at the company? That's what I
So
want to
now that I knew you know, it's great that you asked that. So the first thing is that there are three there are three people in the picture who are still at the company, and three who have retired,
Yeah,
and two who have left.
okay. That's pretty
So
good.
and the retireds is great. Howard Smith, who was my longtime
Oh, I
partner
know.
and president of Walker and Dunlop, retired at the end of last year. And
He
but
was the yin to your yang.
yeah, that's exactly right. It was
Howard
great.
is
And I will say, Bob, I mean, you've also done this of, the evolution of management teams, and I've been blessed to have an extremely I haven't lost anybody on my senior management team as it relates to someone saying this isn't a place that I want to stick around and
um,
keep growing. And the blessing of that though is when you see like Richard Warner, who was our chief credit officer, he retired, and seamlessly we had a new chief credit officer come in, and David Levy took over from Richard Warner, and then David Levy retired, and now Steve Smith is our chief underwriter. That type of evolution of leadership and having it all work where people have had full careers and then retire is really quite something, and says a lot, I honestly believe, as it relates to the overall culture inside of Walker Dunlop. And you can have success in a stock price or in your financial success, but that doesn't necessarily mean that people stick around and want to continue to create
no.
value. And so that combination of both of those things has been very valuable.
Well, it definitely underpins your success because what I've experienced, uh, both when I was at Kennedy Wilson, we were a public company, and now privately as a high growth company at True America, is sometimes the people that start with you, although they're great people, sometimes don't evolve at the same pace that the company evolves, or some evolve faster. So it's pacing that is the big challenge, I think, for matching personal growth with company growth and how people respond to both pressure and work demands.
Completely concur. And the one other thing I would say is that, scaling a company also provides the opportunity for people to move from one place to the next. When we were a much smaller company, if somebody was, in one part of our company, there really wasn't the ability or need for them to be able to move somewhere. Since we have grown so much and bought so many companies and expanded our service offering so much, I have the great luxury to sit there with someone who's a very talented executive and say, thank you for running that. Let's think about you going and running that. And so I have a number of people in my senior executive team who, sort of had capped out as it relates to what they were doing in one place in the company. And fortunately, because of our growth, I've had the ability to give them new opportunities and new challenges to move into new areas, which has been a great part of our growth.
Completely support that. What I have said to our team as we grow is that when we start new businesses, we expand regions, it creates opportunity for people within the company to grow with us. And I mean, I think that's part of the American corporate culture, but nonetheless, it's managing, it's navigating it, which you've done so capably. But let me shift gears for a second because I just want to, I understand, and I think the viewers do that. I don't know if you answered me, like, why did you guys go public? Like, what was the top two or three reasons when you did?
So we had just real quick, we had so we had a Fannie Mae DUS company called Green Park Financial.
Right.
And in that company, we had AIG as our 49% partner. So my family owned 51% with a couple other executives owning shares, and AIG owned 49%. And I had gone to AIG when I joined Walker Dunlop in 2003. I went to them in 2004, 2005, 2006, and it said, hey, I want to grow. I want to start a conduit. I want to do more of this. I want to do more of that. And they kept saying, we're an investor in your Fannie Mae DUS business. And that's really why we're an investor. So don't think about doing anything else. And oh, by the way, AIG does all of those other things. So we don't really need to put capital to you going and doing them. So I turned to my dad in 2006 and I said, I'd like to buy AIG out. And my dad said, okay, if you can get to a price and you can raise the capital to do it, go ahead. And I guarantee you, he A, didn't think I could get to a price, and B, he was certain I couldn't raise the capital. So I went out and got them to a price, and then I went and raised the capital to be able to buy them out. And we bought AIG out at the end of 2006. And you know the history and where we were in the economic cycle at that time.
Oh, yeah.
We go into 2007. And I'm like, maybe we ought to recapitalize the company with private equity or someone else. And in the process of doing that, a couple of people came and said, we want to buy the company. And we went down the path with a big investment bank to potentially buy Walker and Dunlop. And then boom, in May of 2008, the world turned upside down. The investment bank that was looking to potentially buy us backed away from the deal. And then Fannie and Freddie went into conservatorship. And I didn't know whether I'd missed the opportunity of a lifetime to have sold the company before the window shut, or whether we were sitting in the catbird seat because Fannie, Freddie, and HUD were the only capital on the face of the planet. But long story short is we were able to grow in 8 and 9, but I still had the debt that I'd taken on to buy out AIG. So through the great financial crisis, while we were doing well, I was sitting on any ratio. We were a very levered company. So I really wanted to get rid of that leverage. And so bankers came in 2009 and 2010 and said, maybe you bring in private equity, maybe you do a JV with someone, what have you. And then an old friend of mine named Chauncey Dewey, who at that time was at KBW, said, why don't you think about going public? And this part of it, Bob, is just, I was ignorant enough and arrogant enough. And I mean those two things fully, ignorant enough and arrogant enough to say, oh, sure, let's go do that. And so we had, barely the scale to go public. We went public with a valuation of $220 million.
Did you have the management infrastructure, or did you have to add to the management team?
No, we had, I had to hire a general counsel and things of that nature. But one of the things that I'd done that was, I think, pretty smart was I'd moved to one of the big accounting firms when I didn't really need to in 2007 or 2008 to make it so that we had KPMG as our auditor to go public with, right? But I mean, we were the first mortgage company, single family, multifamily, commercial. We were the first mortgage company post GFC to go public. And so when we went out on our IPO roadshow, the word mortgage was a 4-letter word. I mean, it was 4 letters. So to get investors to buy into and we went public at a $220 million market cap. I also didn't know at the time how difficult it would be to get institutions to buy into such a small offering. So look, we went out, we became public, and fortunately the investors in Walker and Dunlop have done exceptionally well over the last 14 years. But as you well know, Bob, it comes with both its pros and its cons. It comes with
Right.
the pros of the year before we went public, I had for the head of marketing at Walker and Dunlop to have 100 press hits in the year, 100 press hits in the year for Walker and Dunlop as a private company. On our first earnings release, I think there were 1,450 news articles written about our first earnings release. And so, in other words, you get that promotion, you get the
Yes.
brand behind it. And at the same time, as you accurately say, I had to go hire a new general counsel. We spend millions of dollars now on an annual basis and all the regulatory things we have to do to file to be a publicly traded company. But the other piece to it is if you think back over the 14 years, had we stayed private, anyone joining Walker and Dunlop would always be like, oh, when's the trade that Willie goes and takes W&D and sells the company because someone comes along and says, it's your payday, you're ready to go, let's do it. And so having been in a public format with both equity to be able to reward team members, as well as being able to say to prospective employees and bankers and brokers, you're not going into a company that's going to be in play at any point. We've got our capital structure figured out, has been a really, really big benefit to us versus some of the smaller private firms who people are always like, oh, is this company going to be sold at some point and I'm going to become part of a much bigger firm? One example of all that would be when JLL bought HFF. The
Right.
disruption that took place when HFF was bought by JLL is
Well,
renowned.
there were a lot of bodies scattered over the field.
You got it. And so that's been a big advantage for us as we've gone through our public life.
Yeah, you've done it in a very holistic way. I know you've made a lot of great acquisitions, but when you really look at it, regional mortgage originator and servicer to DUS lender provider to a much larger servicing platform, and now investment sales, equity, and also the principal side. It's been an amazing evolution of what started as a very modest mortgage company.
Yeah, I mean, look, the thing about it is the what that's allowed us to do. I mean, it was really nice when there were 46 employees at the firm and I knew every single person at the company.
And who their children and their spouses
Exactly.
were.
And you
Can you name their
can
dogs though, Willie? I see your dog in the background there. Could you name their dogs? That's what I want to know.
I can name Simba who's behind me. Some of my colleagues' dogs, I actually do know their names.
You have the dog's birthdays in your contacts. That's what I want to
So
know. How fastidious are you?
As I think I do write birthday cards to everyone at Walker and
I know
Dunlop,
you
and
do.
and it as we were a company of 46 employees, that wasn't a huge task. As we've
Yes.
become a company of 1,400 employees, that becomes a much larger task. And at the same time, when we were about 500 employees, I'll never forget, one of my board members said, isn't it sort of time for you to give up writing birthday cards to all the Walker? Don't you have kind of better thing to do with your time? And I looked right at him and I said, the day that I don't have time to thank someone who is dedicating a very significant part of their life to working at Walker and Dunlop on their one special day of the year is the day I shouldn't be CEO of Walker and Dunlop anymore. And obviously that has limitations in the sense that,
Yes.
let's just say that we were a company of 10,000 employees. I don't think I just physically could do it. But
Well, I think your moving to AI would help you there.
yeah, no, but that's the whole thing,
AI
Bob.
birthday cards by Willie. What do you think?
But as you well know, Bob,
Yeah.
as you well know, because you and I have this kind of relationship with one another, if it was all rudimentary, if your assistant was the one who was calling me or sending me something and you didn't even know that it had come across to me, then it's just that it's kind of it doesn't have the same impact. And so it's similar to the research that you do for this conversation of really diving into it and understanding it, and that someone didn't just hand you a script to sort of say, oh, Willy Walker's coming on for the conversation and here are the cliff notes on who he is. It's that engagement that
Yes.
makes the relationship so real. And so, on the birthday cards, I write every single one. I don't just sign them. I say, dear Bob, I hope the 29th of December is a great day. And so even though some of them I never even met, they know that I've at least sat there and said that it's Bob's birthday on the 29th of December, and I'm going to take some time to write him something rather than just a signature. And it makes a difference. It
Well, it
really
makes you,
does.
it makes you, it builds culture. It
Yeah.
really builds culture. It personalizes the CEO and the experience. Let's shift gears for a second to some timely social and business issues. You made an incredible move into the LIHTC space which seemed like it came out of nowhere. It obviously was a good synergy with your mortgage business, from debt origination and so forth. But, and we've seen this play out at the ballot box, the issue of affordable housing, of rent control. It takes on so many different factors of politics in the country. But you've done it. You've moved into this space. Talk about that a little bit, because that was a major move for you on the principal side as well as the service side.
So your comment of it sort of came out of the blue. I would underscore, because it's thanks to Greg Florkowski, who's now our CFO, who was running business development at the time, that, I mean, the first time he brought me the idea of acquiring Alliant, I had this sort of reaction of like, why would we do that? And so it's Greg's brilliance that got us to go focus on Alliant. Um, and Alliant is an incredible firm, and Sean Horowitz,
I
who,
know
who built
Sean.
Alliant, and Sean is just an amazing entrepreneur and leader, and terrific friend of mine. But the what's so important from a strategic standpoint, Bob, is this: Fannie, Freddie, and HUD, where we are today, the number one Fannie Mae DUS lender, number two HUD commercial lender, and number three Freddie Mac Optigo lender. So we're one, two, and three with Fannie, HUD, and Freddie. All three of them are very focused on affordable housing.
Right.
It's driving
Mission
their
driven housing.
mission-driven affordable housing. And so when you think about adding to our size and scale with Fannie, Freddie, and HUD, the ability to syndicate tax credits and provide equity to those deals, it just makes perfect sense. You want to, we would be able to go to somebody who is a big affordable developer and say to them, hey, we'd love to do the permanent financing on that affordable housing project that you have, and we can do a HUD financing, or we can do Fannie or Freddie, and they want to give you really, really competitive pricing. And then they'd said, well, can you raise the tax credit equity for us? And we'd be like, well, no. And they'd be, well, look, I'm going to go to Wells Fargo. I'm going to go to somebody else. And so it made all the sense in the world for us to enter that business from a strategic go-to-market standpoint. And I think the other piece to your question is that we really do have an affordable housing crisis in America. Um, I had the CEO of Avalon Bay on the Walker webcast about a month ago. And when Ben and I were having our conversation, Avalon Bay has 281 apartment communities across the country. You know them well. You have assets
Mhm.
that sit right near Avalon Bay community.
Well, we purchased from them. We have Avalon assets, and I know Ben Shaw is a great guy.
Exactly. And I was talking to Ben, and Ben said, look, the average delta between living in an Avalon Bay community in the regions where they are, in those 281 assets, the average delta between living in an Avalon Bay community and owning a median price home in those communities is $2,000 a month. $2,000 a month. So his point was, until that gap comes down to the point where a renter from Avalon Bay could move into a single family home, and certainly a lot less than $2,000 per month, Avalon Bay is going to continue to have very, very full communities, and their ability to, charge market rate rents and move those rents, not aggressively, but move those rents well, it's not unlimited. But the point is that people can't afford to move from rental housing into single family housing today, given where rents are and given where rates are and given the lack of supply on the single family side.
Yeah.
And
Not,
so
yeah, not to get
something's
in the
got to give there.
soapbox about public policy, but what really I think defines the United States' ability to be competitive as a nation and provide workers with housing, affordable housing, are the agencies that were put in place almost 100 years ago. We have a government-backed financing system. A lot of Western nations don't have that, and they don't have a multifamily industry like we do. And I think that fabric is so important to nurture. And now it's even more important on the affordable housing side, because a lot of the growth of America is coming from immigrants and new Americans that are at the entry level of the workforce.
100%. And it will be very interesting to see what happens with the potential privatization of Fannie and Freddie and the new Trump administration.
I don't
Because
see it. I've been hearing about it. I've been on panels with senators and other people I just don't see it happening in the short run. Do you?
I do.
You think under the Trump administration it could get some legs?
I think it gets serious legs.
So you think the credit enhancement will start to come from the private sector? Because that's
No,
really the no.
no,
Okay.
no. I think they'll maintain. There's no way to get rid of our mortgage system is predicated on a government guarantee,
Well,
and
the
so
United States Treasury is a big hedge fund. I mean, it invests.
well, that's a whole different conversation.
And look how much
But
money they made from all those loans they did after the GFC, for God's sakes.
yeah, the thing that I look, President Trump has said that they ought to get privatized. Mark Calabria, who was FHFA director in the first Trump administration, is going to have a role somewhere in the next Trump administration, whether it's at Treasury or whether it's back at FHFA, we will see. But
Does this worry you, or what's your thoughts?
so the really interesting thing, there's a lot of talk about Fannie and Freddie shouldn't be in the federal government. We got to spin them back out and let's go do it. The conversation that's been most interesting over the past couple of weeks is that clearly the Trump 2017 tax bill expires at the end of 25. So we're going to have a tax bill in 25. And there has been a lot of talk about the potential privatization of Fannie and Freddie to offset some of the tax cuts that President Trump would like to get put into this next piece of legislation. If the privatization of Fannie and Freddie stay in that discussion, there are two things that are super important, Bob. The first one is it makes it a 25 issue and not a 26 or 27 issue. And then the second thing is if they are trying to offset the cost of tax cuts, that means by definition, they want to get maximum proceeds for Fannie and Freddie. And if you look at what Fannie and Freddie do today, Bob, they are doing credit risk transfer on every single mortgage they originate in single
Correct.
family as well as in multifamily.
They underpin the mortgage system of the country.
Correct. But as a result of credit risk transfer and not holding risk, their
Right.
ROE has come down significantly from where their ROE was when they were private companies,
Sure,
right?
they've lost their way from an
You got it. So they're both 4 to 6% ROE companies today.
They're kind
Okay.
of betwixt in between.
You got it. And so the issue with it is if you want to privatize them and you want to raise the maximum amount of capital to offset tax cuts, which again, this is the thinking, this is the logic behind it. They could get spun out just as we get them out of the federal government and we'll spin them out for whatever value is possible and go do it. That's a very different path than trying to use them to offset the cost of tax cuts. But if they stay in the negotiation on tax cuts, you want to maximize value. They've got a 4 to 6% ROE. You've got to increase that. The only way to increase it is one of two ways. Have them retain more risk, which I don't think anyone wants them to do now that they've done full credit risk transfer. Or the second thing is to allow them to do more, which would mean that they would expand out the conforming loan limit size on single family. There are plenty of Republicans who say over my dead body to that statement, but go back to what the premise is, which is to try and raise as much capital as possible. They would expand what they do in single family and they would expand what they do in multifamily. So there's a lot of conversation going on this issue right now. And if it stays somehow tethered to the tax bill, it's going to come fast and fury in 2025.
Oh, interesting, Willie. And you don't think that's going to increase the cost of financing to average Americans or the cost of rentership because we've got to charge a little bit more to cover that, to make that cash flow? I mean, the equity markets are driven obviously by cash on cash.
Yeah. So the big question is the implicit for this is the explicit guarantee. And the
Yeah.
interesting thing that few people know is that Fannie and Freddie have never. Fannie was created in 1936, the year before Walker and Dunlop was created.
Amazing.
They were created, and since they were created, and then Freddie Mac was created by the Johnson administration in the 1960s to act as a competitor to Fannie Mae. Since they both were created, neither one has ever had an explicit government guarantee. A lot of people think that when they went into
Oh,
conservatorship,
it's renewed every year.
right. Well, but the bottom line is that neither one of them has the full faith and credit of the federal government. Neither one of them. There is an implicit guarantee behind the bonds that they float that says that if anything were to go wrong, the federal government would step in. And as Hank Paulson did in 2008, the federal
Locked them
government
up.
stepped in and said, great, we're going to take them over. But the point being is that if you talk to someone like Mark Calabria, who knows more about this issue than I think anybody, Mark Calabria sits there and goes, there never was an explicit guarantee. And all these people saying that if you spun them out with an implicit guarantee, all of a sudden the cost of borrowing would go up. He says, I think that's fear mongering. I don't think the capital markets, at the end of the day, if you just spun them as private enterprises, you're dead. There has to be an implicit government guarantee behind
Okay.
them.
I,
And they
I
would never spin them without that implicit guarantee. But you can put a synthetic guarantee behind them with lines of credit and all the other things that Fannie and Freddie had previously, and still, I think, have the cost of borrowing not move materially.
I think you'll be doing some testimony on the Hill here as this.
We shall see.
So we got to work on your profile there a little bit, Willie. Anyway, that was very, very helpful, I think, to everybody because certainly a concern, particularly for owner operators like myself, who really rely on that financing. I mean, we do bank financing, we do debt funds and so forth, but as you know, it's a very important part of the multifamily industry. So it's interesting to get your perspective. Let's talk about the rate environment right now. It's been spastic. We've seen the 5-year and 10-year fluctuate. It's created some uncertainty. Everybody thought 24 would be a more robust acquisition year, but it's really taking longer to get back to the new normal of adjusting to a 4+% 5 and 10-year rate and for cap rates to adjust. How's it affected your business? I know you're closing loans. I see announcements. You just did a couple $100 million loan in Miami. You guys are always active, but how is this affecting you and what do you see as going on the pathway here going forward?
So there's a lot behind that, Bob, as you well know.
Yes. It's
And
a lot to unpack.
you and I are both old enough to have operated between 2004 and 2007 when the 10 years sat in a band between 4 and 450.
I remember LIBOR at 600 plus a 300 spread on my first deal at Kennedy Wilson. I borrowed
Right.
at 9. And these
Uh,
people they deal with today say, "Oh, what about negative leverage?" Well, it was a 7 cap borrowed at a 9, but we had growth.
right.
So the
Exactly.
paradigm has shifted.
But I mean, remember how many professionals in the industry, Bob, have come into the industry in 2010 and have never seen, a 10 year with a four handle on it, much less the type of negative leverage we've been talking about. So, look, I think first of all, experience and perspective have a big play. And to be brutally honest with you, a lot of the most what I would call successful owner operator developers in 2024 have been those people who have the perspective. They understand how to get things done in markets that aren't just, up and to the right. The second thing on it is just that there's a lot of business to be done when a 10-year is sitting between 4 and 5%. So the issue that we have had to deal with and digest is that, as you well know, cap rates lag interest rates. So as we were in a rising interest rate environment with cap rates lagging interest rates, it was almost impossible for anyone to get a deal done. Then interest rates stabilized, cap rates moved up and got to or above interest rates. And then all of a sudden we had a rate cut and rates came down. And when the 10-year got to 362 in late August, everyone said, wow, this is great. Cap rates have moved up into into the fives, and I can borrow at 485. I'm back in money. I'm back in the money and I can go.
Yeah.
And then all of a sudden, rates started to move back up. And where we sit today is either slightly positive, slightly negative, or neutral leverage on acquiring a multifamily asset. And some people are like, I loved it when I had 75 basis points of positive leverage, but I'm not sure I love it when I've got negative 25 basis points of leverage. So what you had was a huge rush of transaction volume in Q3. That's carried into Q4, but a lot of that was deals that were put under contract in Q3. And so the transaction volume, I think right now is looking at waiting to see how things play out going into the new year. So there was a huge rush. It still is going along, but nothing close to what the level was in Q3. I would think, because we've seen client after client sit there and say, my borrowing cost went up by 40 basis points, went up by 60 basis points, but I'm still going to proceed to the table and close on this transaction. That a lot of people are saying, I'm looking at an oversupplied 24 market, a relatively oversupplied 25 market, and then a wildly undersupplied 26 market because there are no shovels in the ground right now. And as a result of that, I'm fine buying here because I'm going to get the rent growth that you just talked about on when you were, buying at a 7 cap and financing it at a 9% interest rate. And so I think a lot of people are building into their models the rent growth that's being projected for
Yeah,
26 and 27
they
and
have to.
continuing forward. And then the final thing I'd say, Bob, as it relates to volumes, is just that there's an incredible amount of paper that needs to be rolled that has been getting extensions from 23 kicked into 24 and from 24 kicked into 25. I was with Jamie Woodwell of the Mortgage Bankers Association a couple of weeks ago in DC. And I said, Jamie, look, about $300 billion of loans that matured in 23 were kicked into 24. What's your expectation for loans that were maturing in 24 kicked into 25? And he goes, about the same, Willie. We think it's going to be $300 to $400 billion of paper that was maturing in 24 that's been kicked into 25. You add all that up, Bob, and there's somewhere between, on the low end, 800 and probably on the high end, $1 trillion of commercial real estate paper that needs to be refinanced in 2025. Now, banks and other lenders might just continue to extend and might just say, look, it matures in March of 25 and I'm going to kick you down to March of 26. But at some point, all this paper needs to get redone. So for a firm of our size and scale, to your point about, I appreciate you seeing the press releases we put out, there's going to be a lot of refinancing volume in 2025 to go after, regardless of what happens on the sales market. But I also believe that there's a lot of pent-up capital and also the need to return capital to investors that will make the transaction market work as long as we don't have massive volatility in either cap rates or interest rates. You get that vol, and as you know better than anybody, it's hard to make a deal work. You're sitting there with Noah and no one's saying, hey, Bob, I can't tell you what my financing cost is. And your acquisitions team's going, I can't tell you what, Matt's sitting there going, I can't tell you what the cap rate's going to be. And you're like, well, then why are we in this market? But if you can get cap rates to stay stable and you can get financing costs to stay stable, Matt and Noah can figure those two things out to say, Bob, this is a good acquisition. Let's go do it. And you go do it.
I have to bang their heads together a little bit once in a while, but I'll give you a snippet of exactly what you just said. Last night I was flying back from a day in Miami and Orlando, and a lender who will remain nameless was on the same flight, and Matt had queued me up, and I said, I'm in seat XX, come on over. So sure enough, he was coming back from a bankruptcy hearing on a deal that we looked at 9 months before, with the seller's in denial, the lender's standing by, who's going to fire first. And now it's going to get worked out going into 25. And this probably started maybe even in 23. So it takes a while to work things through the system. And I think we are going to see more product coming on because time's up, whether it's at the lender level or at the equity level. And we've seen great opportunities on the equity side in purchasing through basically that. It's a time's up situation. But I think this is not 2009 or 2008. This is a different time. I think there's much more stability in the multifamily business, and I think that's why the transaction volume has actually slowed down, because people that can hold are waiting a little bit before they make their next move.
Yeah, and then one other thing to keep in mind is if you go back to 2009, the B REIT didn't exist in 2009. The S REIT didn't exist in 2009.
Correct.
And the volume that those two, and then there are lots of other ones in there, but the B REIT and the S REIT being two of the largest ones, the amount of institutional capital that's in the market is unprecedented, right? And as a result of that, those institutions have differing pressures on them than individual owners did back in 2009 or 2010. So, there are fewer and fewer sort of mom and pop owners of assets. It's become an institutionalized asset class. And as a result of it, those institutions have the need to have returns go back to their investors, to deploy new capital that they've gone out and raised very, very successfully. And all of that drives transaction volumes into the market. And so with any luck, what we're really looking for, it's not so much where the price levels are, it's that you have stability in pricing and cost of capital that allow entrepreneurs like yourself to figure out where value is and whether you're going to go make a buy, whether you're going to go make a sale, and then the rest kind of follows downstream.
Yes, very much so. There's an opportunity. It is an entrepreneurial business, but it is becoming more of an institutional business, both from a scaling and efficiency standpoint. But let's talk about we have a lot of younger viewers, and I think they look toward leaders like yourself and want to better understand how you, as an individual and as a corporate CEO, how do you balance your leadership demands with staying innovative and staying at the edge of opportunity? I know you've gotten into the AI a little bit from an inside standpoint. What keeps you motivated to keep innovating in your business, and talk a little bit about that and leadership, if you will?
First of all, if you're not a little bit scared all the time, I think you're failing as a leader, right? So, you and I interface with enough colleagues and competitors in the marketplace that, when you said you flew back last night with some banker at a competitor firm, immediately my mind goes to, okay, who am I missing out to? And should I have been on that flight with Bob so that
I
I
knew
can,
you were going there.
exactly. But that's the
Oh, you'll get to
mentality.
refinance it for me. Don't worry.
No, but the point, Bob, as you well know, you got to have that mentality. You've got to have that,
Yeah.
like, what am I missing? Should I have been there? When you see your competitors buying an asset and putting in some amenity that your team hadn't even dreamed of, you say, whoa, hang on a second. Like, where's the market going? What do we need to do on our next
Why aren't we
acquisition?
doing that?
Why
Exactly.
aren't we doing that? And so if you're not a little scared, you shouldn't be in the seat. So there better be something that's driving you a little bit to be constantly a little paranoid about the competition. And then I think the second thing is just, continuous learning,
Reading.
reading and listening. I love sitting down watching football with my kids, but other than watching football with my kids, I watch very little television other than CNBC when I'm working out. But I listen to podcasts voraciously. I wake up in the morning and read the Wall Street Journal. I get the physical Wall Street Journal because I don't
What
do
time
it
do you get
well.
up?
And so I have the Wall Street Journal and I read it every morning, cover to cover. And I
Before
think
the
that
10 or 15-mile bike ride.
well, no, I mean, I listen when what I do on my
You're
bike rides is I
multitasking. I
listen.
get it. All right.
I put in podcasts when I'm on my bike. But I think that it's that, if you're not looking around and thinking about what else is out there, younger people who may not have the same responsibility that you or I do, Bob, both of us had our journeys to getting into the seats that we're both in today. And, a couple things on that is, first of all, I always felt that I could out hustle the competition just from a work standpoint, but that I was never going to outsmart the competition. I don't show up and people say, wow, you're the smartest guy I've met.
But
And,
you
but
show up.
I always knew that I could work harder. And
Right.
so, you don't have to be gifted with the most innovative brain, but if you dot your I's, cross your T's, and work harder than anyone else, you are going to succeed. And I think that that's one of those things that a lot of people miss. They're sort of like, oh, I didn't go to this school, or I didn't have that opportunity, or I didn't work at Goldman Sachs. So how am I going to get up there? There is absolutely every ability in the world for anyone to work up the corporate ladder as long as they are super diligent and that they work harder than anybody else. I think the other piece to it is, making sure that what you do, the work process product that you put out is really good. Um, we have loan narratives on every loan that we do. Those loan narratives have to be done well. They have to be done with an eye that says that when I sit down to read that loan narrative, I know that it's been done really well. And by the way, I've had really, really smart kids who went to exceptional universities join Walker and Dunlop, get on an underwriting team, and write a loan narrative that had English in it that I would think someone who never went to college would write. I mean, in other words, really, really crappy stuff. And so making sure the work quality is really good is like so important to just being ready to take that next step of responsibility. And then
Well,
I think the other piece to it is the relationships that one builds both in the industry and outside of the industry. You have got an incredible reputation in the industry as Bob
thank you.
Hart as an individual, and then also having run Kennedy Wilson and True America and all the other things that you've done. Um, I think people forget about the importance of those reputations. Those things come back. There's something that you did in 2008 that allowed you to maintain the reputation you have in the marketplace today in 2024, that had you not done that in 2008, you wouldn't be where you are today. I'm 100% certain of that.
Well, I think it comes
And
from running a good process And you've said that in a couple of things. You talk about how people write or prepare documents. It's that integrity that leads to a better company or a better community. It's the process of doing that that builds the leadership qualities and then holding people accountable to it. I could do business with someone that I had a not so great deal with, but they remember that the process we went through was a good process and a fair process, and they weren't ground into dust over something. They'll remember that whether they made $1 million or $100 million. It's more about, I think, the quality of the process and preserving the relationship, whether it's internal or external.
100%. And the other thing that I would add to that is that at some point you need to take risks. And
Yeah.
you and I have both taken risks with our personal careers and with our companies that are calculated, but you must be willing to take risk. And if you want to really move, and I don't say that in the sense of like you need to be at a company and constantly out looking for the next opportunity and that's quote unquote taking risk. What you need to do is be able to go to, your boss and say to your boss, you've got me here. I'd like to go there. And in saying what you want to do, you might find your boss looks at you and says, you're in no way qualified to even have that conversation with me. But unless you put out there what your goals and ambitions are, unless you take some risks to express where you want to go and what you want to learn and what you want to earn and what kind of a career you want to have, you must do that. You must advocate for yourself. And look, as and I'm sure you're the same way. I mean, like we have someone, we just had to retain someone at Walker Dunlop a couple months ago, right? They had an incredible offer from a competitor firm to go to them. And did I like having to go out and figure out what the stay package was and what the redo of the compensation agreement was and all that kind of stuff? Of course I didn't, right? It costs us money. It's a lot of work. And I felt, a little insecure that this person might be taking off. But the offer they got from one of our competitors was incredible. The bottom line are a couple things there. First of all, it's my job to solve that problem, not complain about that problem. The second thing is it's great that we've got people at Walker Dunlop that others want. It's great. It's a statement of the type of people we have that the competition is making big offers to have them come across.
It's a
And the third,
compliment, Willie. I used to get mad about it, but it's a compliment.
it's 100% compliment, 100%. And then the final piece to it is the best thing that you want, which this person said was, look, I don't expect you to match what they did. I got lucky. They came, a headhunter called me. They said they'd like me to come. These are the terms and conditions. You don't have to match it. You just have to make it so that staying here has the same value for me that I would think leaving would. And that's also a very big privilege that they would talk to you about it rather than showing up in your office and saying, I'm gone. And second of all, saying, I'm not expecting dollar for dollar match, but guess what? This is on the table. You got to do something about it.
Now, I think when you become either the commissioner of baseball or the head of the NFL, you can give that speech to all the owners as they're negotiating player salaries, teaching people how to stay at the same team.
Unfortunately, there's some antitrust laws that make it so you really can't have that. And by the way, Bob, as
Well,
you
that'll be after Walker Dunlop.
no, but as you well know, the other thing that kind of drives me crazy about that is that was some competitor who was basically just making my cost of operations and their cost of operations go
Of
up.
course.
But you know what? As I got kind of pissed off at the beginning, Don King, who runs our capital markets group, turned to me and he goes,
I love Don. He's a great guy.
Don't get too pissed off because we did the exact same thing to them 6 months ago. So it was like one of these things of sort of like, you can't sit there and get all too upset about it because that's part of business. But all of that also, Bob, goes into this, which is that I think a lot of people miss how challenging and also positive a capitalist society is. In other words, like that whole thing that I just described to you, it's hard. It costs a lot of money. It makes everything unsettled for a period of time.
Particularly if you have a service company because you rely on your talent.
It makes us better. It makes everyone better. It makes the system better. And this concept of just sort of, we don't want that kind of competition in the marketplace. We don't want people, doing this or doing that. The challenges that a capitalist society bring to us is what makes it's the foundation of this country. And it's so valuable to making all of us better.
Well, there's nothing like the spirit of democratic capitalism to move a society forward. And whether it's a company or a country or whatever it is, it's having that opportunity. And what I tell young people all the time when I speak at conferences, well, how do I get into your business? How do I become like you? Well, you know how you do that? You put some skin in the game. You make an investment. I made my first investment when I was 29 and I cobbled it together. You've made investments to building the foundation of your company. So it's whether it's asking for the next ladder or making the next investment, it's about taking the initiative and doing it and showing up to do it. The theme of my podcast has been about building better communities, whether it's in education, in business, or healthcare. You've done that at Walker Dunlop. Talk a little bit about how you've gone beyond. I know you're involved with your university, or you do many things, but talk a little bit about how you're building a better community for the people that you touch.
So one of the things that a number of years ago, I sort of stopped and said, we've been able to build a really successful company, but it's basically been built off of um, business plans and a focus on execution on those business plans. It hasn't been built with a broader mission statement of making it. And by the way, we were plenty charitable and did lots of things in our communities, but there wasn't a broader mission statement on Walker and Dunlop as it relates to giving back to communities. And so we changed the mission statement at W&D to from being the premier commercial real estate finance company in the United States to making a difference on the communities where people work, shop, live, and play, and trying to shift it so that people inside of W&D understood that the capital that we provide allows people like you to create communities where people live, communities where people shop, communities where people play, communities where people work. And I think particularly post-pandemic, Bob, the sense of community in America has been somewhat redefined. And the need for community, the need for understanding, the need to be able to talk about difficult political issues and listen to people on the other side of the table, on the other side of the aisle, has been something that has been lacking, and we need to do more of it. And so I think that our shift to talking about the impact that we have on communities has allowed everyone at W&D to sort of sit there and say, this is a major responsibility of me in my job. And I think it also ties what we do of making a loan to True America that allows True America to go create and own a safe and affordable apartment community where people in America can live. And it's that connection to that community that allows people to say it's not just a loan. And so we do, we just did our annual fundraiser last week, and we set up 3 teams, and each team had a nonprofit that focuses on homelessness and getting people back on their feet who happen to be homeless or struggling from a shelter standpoint. And, it was a big competition between the various teams to see who could raise the most amount of money. And we ended up raising $250,000 from W&D employees, and then we matched it. So we raised $500,000 to give to those 3 charities.
You know what my saying is when people don't want to give, right?
What's that?
It only hurts for a minute.
Yeah, exactly. Well,
Now, I've never had to say that to you because whenever I reach out for whether it be Chrysalis or any organization, you've always been there, and I appreciate it. But it has only hurt for a minute.
Yeah,
After
and
we give, it's over.
and it also, it doesn't hurt. I mean,
No.
at the end of the day, it's I mean, the need to give back, there is a need. And I think a lot of people take for granted that most of the people in our industry who work at a True America or work at a Walker and Dunlop, they're well educated, they have a great job, they're in a great industry in the greatest country on the face of the planet.
They're
Right now.
lucky. We're all
Right now.
lucky.
We are beyond lucky. And a lot of people sit there and there's plenty to complain about. There's plenty to be concerned about. If if your candidate didn't win in the November elections, whether presidential or Senate or Congress, you sit there and say, oh, my leader didn't win. We're blessed that there was an election that had more voter turnout than we've ever had, which means that democracy expressed itself. Democracy expressed itself fully. And you may say, I either love it or I hate it, but that's democracy at work. And we are blessed to have a democratic system that works. And so the whole piece on community is super, super important. And I would say the other piece to it, Bob, that you do and your podcast is doing it, is, through the Walker webcast and what I've now done we're celebrating our 5th year of the
I know
Walker
you started in the
webcast.
pandemic. You've
The
done it
5th year, we
very
started
well.
at the beginning of the pandemic. So half a decade is going to have gone by in March when we have our 5th anniversary. Um, and I have a guest for that who has given me a tentative yes, which I'm super excited
Oh
about.
my God, I don't want to miss that one.
Yeah, no, it'll be great. But the on that is part of giving back. And we don't make money off of the Walker webcast.
No.
It's a labor of love for me. I'm privileged to have incredible guests come on. And just like you, I mean, you and I both have this hour, you and I could have been out doing deals.
Sure.
Both of us could have been doing something that's making True America or WND more money than either of us are getting for doing this hour and a half together. And at the same time, we both have a responsibility to also be sharing ideas. And so that some young woman or man who wants to be the next generation of Bob Hart or Willy Walker can listen to this and sort of say, I heard that thing and maybe I ought to think about doing that. And that's part of giving back.
Well, very well said. I'm going to ask you one final question before I let you go, because I know you're heading to London here tonight. You're a very introspective person. I've seen that in full display. So, but tell us about, I guess, either your favorite mistake or your favorite humble moment that will still bring a smile to your face, and maybe what you learned from it.
That's a long list.
You
Um,
could pick any one you like.
yeah, no, I know. Um, I mean, the most glaring is the fact that, my first wife and I got divorced 2.5 years ago.
No, it was
I
hard.
view
I know.
that as a big failure on my part. And at the same time, it humbled me, it hurt me, it upset me. And at the same time, because both of us treated each other with the utmost of respect during that difficult period of getting divorced, we celebrated my son's 22nd birthday last night, and Sheila was here, and our 3 boys were
Oh,
here, and my 22-year-old's girlfriend was here. And if you looked at the pictures from last night, you'd say that's an amazing family. And we are still an amazing family, even though Sheila and I are fully divorced, and neither of us has any interest in ever putting it back together. And I have a girlfriend, and I'm extremely happy with my girlfriend, Sarah, and we have a great relationship. But I look back on that and what I learned out of that, how humbling an experience it was. One quick aside to that, Bob, which I do think is an
mhm.
important one. Um, when I when I went out, Sheila and I split back in 2016 for the better part of a year, and then we put our relationship back together, and then we ended up getting divorced 2.5 years ago. But on that first one, where I had to go tell my friends that Sheila and I were
All
splitting,
right.
it was super hard. And I called up my 8 closest friends in the DC area and invited them all to lunch and had kind of these one-on-ones with them saying, this is happening and I feel awful and I'm getting a new house and blah, 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 blah. And in each one of those luncheons, my friend would tell me something about his life that he hadn't told me previously that was a big opening. And I got done with like luncheon number 5. And on number 6, I said to this buddy of mine, a dear friend, Rick, I said, in each one of my previous 5 lunches, someone's come up with something about their daughter is anorexic or their son got kicked out of school or whatever the case of something that I didn't know about. And they shared with me. And my friend Rick looked at me and says, well, that makes all the sense in the world. And I'm like, what do you mean it makes all the sense in the world? I feel awful. They didn't tell me ahead of time. He said, the idea was that you're like the Teflon guy, like everything goes
All
right in
right.
your life. And now you've come forth with a failing and you've been open and honest about you taking accountability for it. And that then gives them the opportunity to share back with you where previously they didn't feel like they could share some weakness or some failing or something that was going on in their own life. And it was a huge eye-opening moment to me as it relates to, the image of everything goes great and I'm really this or I'm really that internal voice. it in many times serves you a disservice of really getting to know people and allowing people to entrust in you that you too are human and have failings and have shortcomings and all that stuff. And it taught me a ton, Bob, as it relates to just being real and being honest and open about things that we do well and things that we don't do so well, always with the view of hopefully doing them a little bit better next time around.
Well, Willie, your own personal vulnerability and how you've expressed it without necessarily giving someone advice, but giving them insight is remarkable. And as a CEO of a public company, you've really set the pace for what it's really you've humanized your role, that I think provides tremendous leadership for everybody. So I really appreciate that, and I applaud your just the way you've run your life and you've run your business. So thank you very much for coming on today. Have a great holiday, and thank you for being here.
It's my pleasure, Bob. It's
And
having.
happy anniversary.
Thank you, thank
14
you on the
years.
anniversary of the IPO. And
Unbelievable.
look, it's you're a great friend. I feel, one of the great parts of business is we spend so much time at the office,
You
and we
do.
spend so much time working with others. And when you have people that you work with that become real friends, not business acquaintances, but real friends, that's a great blessing. And I truly count you as one of my great friends, and I'm super appreciative of you inviting me on and the conversation we've had and all that we do together.
Well, I have to share one other thing as we part, because you know how to elevate people. So I want to share my favorite wall plaque.
Oh yeah,
Powering
yeah.
Your Prosperity by Bob Hart and Willy Walker. Okay.
Nah, that
That
was
was a
that
great
was
campaign that you did, and I really enjoyed getting out in the water and doing that for you. So you need to revitalize that, Willie.
But Bob, just on one quick thing on that, which is a really important one. Marketing needs to be about the customer, not about the company.
Clearly, you made it about the customer.
It has to be about the customer. In other words, like the idea of like, oh, W&D is really all the accolades that you could put out there of how big we are, how successful we've been, all that kind of that doesn't matter. What matters is the customer. What are we doing to meet your needs? And that ad campaign where we went, and by the way, we did you really early, which shows you how high in my list of friends you are. But the point is that I sat there and said, let's expose our clients. Let's tell the world how great our clients are. And it really was, I think, in hindsight, a fantastic, it was a fantastic campaign because it wasn't talking about Walker and Dunlop. It was talking about you.
And it was
When
fun.
you make it about your clients, they sit there and say, whoa, like they're appreciative of me and my business. And that's a huge marketing lesson for anyone who's sitting there saying, like, what's the next thing we're going to do? Particularly in smaller companies. Smaller companies think they have to. Look, we were a teeny company. I felt we're competing with CBRE and all these huge
Sure,
companies
you
with
were the
big
little
brands.
guy then.
I've got to show the world that I'm as good as they are. You need to show your clients that you're invested and focused on them. And then you can show everyone that you're as big as CBRE, because you're going to get the clients, you're going to get the business, not because you told everyone I'm trying to be like CBRE. It's that you're doing what your clients need you to do. And then you just grow.
Well, really amazing. You always go the extra mile, whether it's running, biking, or for your clients. So have a great holiday, and
Thanks,
sure
Bob. You
that
too.
Sarah gets to the airport okay, and
Let's hope. Let's hope we get to London.
All right, tally
Same to
ho.
you, my friend. Take
All right,
care.
bye,
Bye
Willie.
bye.